So today we thought of getting you a fund manager who hasn't been on the channel but a dear friend, and he's coming after a long time. He was busy building his PMS to even bigger size and was traveling a lot. I'm talking about Stallion Assets, Amit Jeswani, who is joining us back on the show today. Amit, nice to be with you today on the show, and great to have you on the show. You've been working very hard to build your portfolio, so no time for friends, huh?
Ajay, thank you so much. You are the one who's made me come back on television after 4 years. You were the first person I got in television with. So thank you so much for getting me back to television after 4 years. This is my first television interview after 4 years.
Good to have your thoughts. Very refreshing. Clearly. But good to have some refreshing thoughts. Tell us, I was just analyzing your portfolio. The entire market has fallen in love with PSU banks and PSUs in general, be it defense or railways. You have steered clear of that space so far. What is the thought process behind that?
So Ajay, our kind of customers are very happy if we can compound their capital at 20-25%. That is the goal that we have internally for ourselves. So to do the 20-25% kind of compounding that we would like to do with our risk lower than the benchmark. So since inception, our portfolio beta has been 0.85. We don't have to do the PSUs and the defense kind of plays where, they go from very cheap, from very cheap to being cheap and then very cheap again. So these are cycles, but the markets this year has clearly rewarded neglect. Spaces where people like fund managers were not there. Those are the spaces which have done very well, and small earnings growth, and the trick was done. So PSUs in general, we don't invest in B2G business models because we have a 20-25 stock portfolio, Ajaya. We believe that we don't have to go there to do the 20-25%.
Right. In fact, I must tell you that one of your portfolio stocks, clearly you have quite a few very high growth stocks in your portfolio, and we had one of your portfolio companies on my show just 2 days back. Aditya Vision was talking about some great growth plans and 17% same store sales growth, etc. Electronics retailer in the tier 2, tier 3. But I'll come back to that. For a moment, I want to talk to you about consumer tech and the relationship with consumer tech high growth with the inflation in the environment and how discounting of these companies actually happen. What are your thoughts there?
So consumer tech, what we have done is basically we have added 2 consumer tech names in the portfolio. This is just a disclosure. These are not recommendations. We have vested interest in 2 fintech consumer plays. I believe in the first one, which is on the insurance tech side. They are 1% of India's insurance market. The market cap there is 20,000 crores. They have 6,000 crores cash on books. So the enterprise value is 14,000 crores. I believe that if they move from 1% of India's insurance market to 2% of India's insurance market, the profits will be north of 1,000 crores, can be closer to 1,500 to 2,000 crores in the next 3-4 years. And if they become 3% of India's insurance market premium, the profits will be north of 3,000-4,000 crores. We bought it at 14,000 crores. This is in the next 3-4-5 years. So loss is not the right way to look at it. It's about free cash flow loss. Most of these companies are now near profit. If they are like the insurance tech player, which I'm speaking about, is already in profit. The payment player, which I'm speaking about, that is near profit. If in next 1-2 quarters they turn profitable, which I am expecting them to do, I believe decent money will be made in these. So your growth remains at 30-40%. You are like the insurance tech player is 1% of the market, yet it's a market leader with 94% of insurance policies done via that platform, the online insurance marketplace policy. So you don't want to bet on businesses who are number one. You want to bet on businesses who are only one in their segment, market leaders, have ability to grow at 30-40%. And as the revenue growth comes 30-40%, your cost will not grow at the same level. The cost growth will be way lesser. So you'll have a J curve in profits, which will get developed in these kind of names. There was a massive supply, and we were waiting for these supply points, and we have accumulated them. And now fintechs, I would say, are 9% of our portfolio. We of course have our stop losses in place, so we have to manage our risk, but we don't believe the stop loss will get hit. We believe that if we go right, if we go wrong, we lose 1.5% of our portfolio. If we go right, our alphas can be in next 1.5 years, we'll make 15-20% alpha on the 9% position. So that's how we have thought about it. We have made decent sized positions. Now time starts to pray.
Okay. Amit, let's talk about one more big bet in your portfolio, which I see was at one point in time almost a monopoly in consumer lending space. Then they had a massive digital backbone and digital dissemination methodology. Bajaj Finance I'm talking about. But last couple of months it seemed to have gotten sideways. Some are saying a derating is happening because the landscape is getting very competitive. Some other big players like Geo Financial Services may be coming out and disrupting the space. All sorts of things are there. But if you were only to look at the valuation it is available at right now and the space, the lending space, the digital lending space to consumers, how are you analyzing this entire opportunity even now?
So Ajay, I don't think we will be able to compound our capital at 40-45%, which we've done in the consumer finance company in the now going forward, but our CAGR should be, so the consumer finance leader is about, so India's lending market is 110 lakh crores, the consumer finance, and it is growing at 10-15%. That is India's lending market. The consumer lender that you're speaking about, it's 1.7-1.8% of India's lending market. I believe when you look at the credit cost scenario, what this player has done across cycles, it's unbelievable. And if they can continue this and the growth remains at 30-35%, and the AUM doubles basically every 2.5 years, what's the problem? And your ROAs are 5.4% and your ROEs are closer to 20-25%. So these are players that will stay that bit expensive. The markets have derated them from 8-9 times price to book to now closer to 6-7 times price to book FY23. That is okay. There are times where you have to stay with, we also cut. So now the game is simple. When it comes to 6 times price to book, you buy it. When it goes to 10 times price to book, you cut your position somewhat. But you will still get your book value compounding will be 20-25% CAGR. And that is what our customers want. So our customers are very happy. They are not. So it's very easy to say that, boss, why that PSU, what happens, Ajay, in real life, I'm telling you. The ones who made money in steel, they would have gone in sugar. They would have gone in some other ferroalloy or something like that. Now the ones who are making money in PSU will go into something else which is very low quality, and sometime in the very near future they will give all the money that they made doing this low quality investing back, because very few people will be able to so this is a cycle. The ones who bought HEG made money in HEG, they bought Rain Industries. If they made money in Rain Industry, they bought something else where they lost money. But that cycle of making money off low quality consistently, it is very difficult in public portfolios, and I see that globally. I don't see many public managers ever been able to make returns in B2G kind of business models. But right now there's a tailwind. The stocks are making new highs. So if you're a momentum investor, you have to ride the trend. But in our kind of case where you have specific return and risk goals, we don't have to go there.
Very good point. That's a very good point which you made. Amit, tell us, what is the thought process right now? What kind of ideas are you researching and have been adding in the last, say, couple of months?
Ajay, inflation is peaking out globally. So if you look at 2021, from March to December 2021, FI sold 1.5 lakh crores worth of stock. That is near $20 billion. This year, they have sold broadly 2.6 lakh crores. The FIs in last 18 months have sold 4 lakh crores worth stock. I believe 2023, they're going to come back. They're going to come back with a bang. Inflation is going to come down. Your bond yields will come down. So you are looking at a very Lollapalooza kind of 2023, I should say, in our kind of stocks. If FIs come, our kind of stocks do well. If it's only DIs who are bid or retail who's only bid, then value stocks typically do very, very, very well. So that is a very strong correlation that we are seeing, that FIs buy growth, DIs buy value. So the next year, I'm expecting a very large FI kind of year, and we will remain the growth investors that we are. We are just now 5 times more cognizant on the value that we pay. Like till 2021, I would say, if a stock was growing at 40%, till the time it was growing at 40%, you would stay long. But now you say that, you know what, 40% is okay, but I need to buy at the right valuation. That's one change I would say we've done. But we are very bullish, and our portfolio, in my humble opinion, should do decently well in 2023. And we will make changes. We are cutting our betas down. So we are cutting our betas everywhere. Like we had in October 2021, we have moved to low beta. We are now moving back to high beta. And that's how you see the first phase. We bought an electric retailer in Bihar. That has done well for us. We've started buying consumer tech. Hopefully that will do well for us. We've already bought consumer tech. Hopefully that will do well for us. So we are looking at high growth. So the growth part stay you need in India, you can't bet on companies which grow 5-10% and expect that you'll keep compounding at 20-25%. It's not possible.
You've got a couple of retailers also, or retail brands, if I may say. DMart is a household name now as far as grocery retail is concerned. Trend 2 is evolving, and some great commentary coming from the management recently. Titan, of course, a consumer retailer across segments. What is the hypothesis in this pocket, the consumer discretionary / retail?
All of these companies are growing at 20-25%. Titan 3-year CAGR is closer to 28%. That is post like taking COVID into place. DMart revenue CAGRs will be closer to 21%, but this quarter onwards, I believe that will move towards 25%. So when we get that 25% growth, and every year you keep taking market share away from less other players, like Trent has gone from 200 stores to now 400 stores within the pandemic. You spoke about an electronic retailer that has doubled store count in COVID and now doubling store count again in next 2 years. So when you have, see, we need 25 good entrepreneurs who are hyper scaling and their ROICs are 25-30% plus. When you get a combination of market leadership, growth, ROIC, magic of compounding happens every 3 years, and that will happen in any period, be it a bear market, bull market. You don't have to worry too much. And once you get them, you just hold them for a long time, and you be aggressive on a dip. So that's all we do, to be honest. And that you'll see in a lot of names in our portfolio, that the growth and ROICs will keep moving higher from these levels. And once you get these 30% growth, 25% growth, and market chases growth. And that is how markets are. Now also, if you're seeing the rally towards PSUs and the corporate lending kind of bank, that is because the growth increased. The growth of NII of Axis Bank this quarter was 31%. The growth in NII of ICICI Bank this quarter was 26%. HDFC was at 18%. South Indian Bank, the growth of NII was 37%. So when the low P neglect starts showing growth for 1-2 quarters also, the market bids them up very aggressively. And that is what you're seeing. Chase the growth, follow the growth. That is where large, of course, you need, if you get growth, value and neglect, that is where the largest money will get made. But on the compounding side, so Ajay, so let me divide the markets for you. Assuming Nifty has 1,000 stocks. There's a middle line. 25 PE is the broad middle line. There are, on this side of the market, are consumer and tech names which trade at 70p, 80p, 50p. On this side, you have PSU banks like PSU banks, commodities, which trade at 5p, 10p, 15p. Every 3-4 years, 100 stocks move from the low P category to the higher P category, and 100 stocks move down from the higher P category to the lower PE category. And this happens when there is a change of growth rate, change of ROIC, or change of competitive advantage period. And that is what we try to catch. Like APL Apollo, okay, was on this side of the basket. We bought it at 3,500 crores market cap. Right now, it's at this side of the basket where the P's are high at 50 P plus, ROCs have moved north of 30%. So this is where I call it the emerging monopoly basket. And that is where your largest wealth creation happens. So we've got some compounders which are expensive on the right side of the basket. These are expensive compounders. They keep growing at 25, 30%. But we also buy companies which are on the lower PE side, but they have attained market leadership. The ROICs will improve to 25, 30%, and you have growth also coming in. And when the biggest money is made on the left to right basket, when stocks move from left to right. I hope I was able
That's
to
exactly what stock picking is all about, and that's why you're... No, fair point. You made a very valuable point, and that's what stock picking is about, and that's why your investors value your skills and come to you, keep flocking to you. But thanks very much, Amit, for taking time out with us today, and great to have you on the show, as always.
Thank you so much for